A little backstory, guys. I've just had a chair delivered, and the guy got himself locked in the driveway, so I had to go open the gate. uh,
Brilliant. I was just saying, we're going to cover off some additional questions. So things like, um, how do I get my money out of the company? So not just how do I get paid, but when money accumulates within the business, how do you take it out and why it accumulates? The different types of company options available to you.
yeah,
And then things like research and development grants. How does that work? What is the principle on all of that? And how do you get that money back? And a couple of questions that I had were, how do I know if my accountant is doing enough? Now, I love
it's
this
impossible,
question.
isn't it? As a layperson to
Well,
know what's going on sometimes.
yeah. I mean, we'll almost jump straight into that one because I love that question and I think it's fantastic. And then what we're going to really talk about today is that sort of layering on the information. So, right, so we've dealt with new associates coming in, and now where's that next step in your career from a financial
Yeah,
perspective? Um, so really, we'll start off with that question, if it's right with you, Jamil,
yeah.
of
Dive
how do I
into it,
know if
man.
my accountant is doing enough? Um, so how do I know if my accountant is good enough? And I think there's a couple of things that you want to check on that is regardless of who your accountant is, you are always responsible for the numbers they create for you. So
Mm,
what all you've done is subcontracted your duty there. So as a person who's got to submit their accounts, whether you're as part of a limited company or a sole trader, you're still responsible for those numbers. An accountant will produce the numbers you've provided them, and you verify whether they are correct. And I think where the challenge comes from is that really that final point. How on earth do you verify if it's correct? Um, some of the things that we do is really is drive that point home really early on with
yeah.
our clients that says, look, you are responsible for these numbers. Now I'm going to do everything I can to make sure you know what those numbers are, what those numbers mean, so you can ask me an informed question. I think my tagline is putting your financial information at your fingertips, and I put that financial education for the masses because it's an absolute travesty that you're not taught any of this stuff in school. Um,
Yeah.
so it's an absolute travesty that you step into the big wide world, you don't know what you've got to do with it all. So the way we work, and I can't speak on behalf of their accounts because there are some fantastic accountancy firms out
Yeah,
there,
sure.
and I'm not, and they're brilliant. There was only a post made today by Consultant Clinic about how they put a lot of their success down to the fact that they had a financial professional that believed in them from the start and believed in their journey. And that really drives that point home that says you be the expert on the medical side and you outsource some to so the financial element or the business element to an expert that does that. So what we do is we do your accounts throughout the year. So that's the way I like to work. That's the way the practice is set up. So it's very much digital that you get to see the numbers that are created as you go out
Is
through
that on
the
a
year.
monthly
That
basis?
does
How does that work?
almost real
Okay.
time. So I get so the software that I use takes a live feed from your bank account. So historically, what would tend to happen is you get to the end of the year. So your tax year runs April to April, depending on why it's that. I've got an answer for that one, by the way. I did look into why it's April, so I will come back to that.
Oh
We'll
yeah,
save
because
that one
I
for
I
the end. Remind
complained
me for
about
that.
that last time, didn't I?
You did, and I hate not having an answer for a question. So I went away and researched it. I was like, well, I'm definitely going to come back with an answer for that one.
Cool.
So if it runs April to April, and I'm talking about really sole traders at this point, is your tax isn't due until the January the following year. So what most people do is wait till November, December, drop everything off to the accountant that says, produce me a set of numbers. And they'll probably work it off a set of bank statements, or if you've provided all the information.
Mm,
We work in real time. So I take a live feed from your bank account that shows you the transactions as they're happening. Now that does a couple of things. A, it gives you a running tax total that says this is what you're going to pay, when you're going to need to pay it by. That says A, you can't claim this. B, you can claim this. C, I should be seeing something that I'm not seeing. Why am I not seeing it? Have you paid for it on your credit card? Well, if you've paid for it on your credit card, then I want to see a receipt that we can claim it as an expense. And that really starts focusing the question with my clients that says, Bilal, can I claim for this? I mean, I've had clients standing in the Apple store texting me saying, Bilal, can we claim a set of AirPods for a business expense? Well, I'm not going to tell you the answer. So if you want to know if you can, message me. But it's that sort of information that we work on. That does a couple of things. A, it spreads our workload out throughout the year. B, it forces you to ask questions throughout the
yeah, and
year.
you'll understand it
Um,
after a while. You know, you'll almost know the answer maybe if you keep on asking about the similar sorts of things. You'll start to get the gist of what's going on.
that's exactly that, and you've hit the nail on the head. That's why we do it that way. what that also does is it forces conversation. So once you've got a base understanding of stuff, you'll start researching stuff on your own. So you might ask for grants and things like that are open to your business. And if you do want to create something unique in the industry that you want to build it to the point that you sell it, what's the best way to set that up? So it forces you to start asking questions that you didn't really know you could ask before, but as you work with us, you understand that. And I think on the back of the last podcast we did, I had people reach out to me just to verify what their accounts were telling them was any good.
Yeah.
And I'm happy to do that. That really said, again, I'm not here to slate anyone's work, and they've gone back to their own accounts and said, yeah, this is what we'll do. If they choose to work with me, they choose to. If they're not, then not. That's absolutely fine. So I think that really summarizes, how do I know if my accountant is doing enough? Really, it goes back onto yourself. Are you doing enough to get the most out of your accountant?
Yeah. Would you say it's a reflection on your own attitude?
I wouldn't say attitude. I would say it's almost not so much naivety. It's, I think we tend to stay away from things we don't understand. In that, it's almost the great unknown, jumping into a set of numbers which, the HMRC's websites, the tax guidelines aren't written in any sort of English that you'd understand. They're written as plain as they can be, but it's legalese. It has to be written in a fashion that protects both sides. So it can blow people's minds about what they can't claim for. So sometimes they don't even bother, or just try and stay away from it until they absolutely have to do something with it. And that's quite a dangerous. That's a sort of a dangerous method, because you will never gain the maximum tax efficiency by doing that. So, I had a client join me last year who was vehemently said that these are my numbers. I want you to produce these numbers. I said, well, hold on, let me run it through my system. Let me do it the way I would do it. I'm just going to have to truncate it. So, well, not truncate it. I'm going to have to condense it to maybe a couple of days where I can run it all through and then fit it all through. And we ended up saving £1,800 in tax. And then that really changed the way he worked going forward. So I think it really goes down to, do you ask enough questions of your accountant that says, well, explain this to me? So if I was a patient and I was coming to you that says, look, I've got a pain in my tooth, and you tell me, Bilal, you're going to need a root canal. Well, why do I need a root canal? So the onus is on me to understand, why am I having a root canal done?
I wish it was that way, but it seems to be the other way for us. It's like you've got to tell them everything and then make sure they understand it. And if you don't, you can still get in trouble if they don't quite clock it. But yeah, I get what you mean. It's down to your, as a consumer, you're buying a product from the accountant.
Yeah.
Do you understand what you're getting, and are you getting the most out of what you're paying for? It's kind of up to you to do that.
Absolutely. And our model is based on almost a subscription base. So it's almost software accountancy as a service, where you pay a subscription fee, and it's up to you to then draw down against it. You can almost use a Netflix analogy that said, if you only use Netflix to watch one film a year, then you're going to hate the service. But if you binge watched everything, then you're going to absolutely love it, because you're getting maximum value for money. So it's down to your interaction with it. And I know some accountants don't get back to you very quickly because they're not set up in the way that they're set up, and that's sometimes might be a reason to move. But a lot of the time, if you just have a conversation with someone, that they'll be able to have that sort of return with you.
Yeah, makes sense.
But I think that's somewhat, do I know if my accountant is doing enough? Is, are you asking enough of your accountant to explain what they're doing for you?
Yeah. Should we look into? I think that probably sums up what we want to say around current accountants without getting libelous or anything like that. Are there times, though, without again mentioning names, where you have had to really sort things out, or generally people on a good level?
I think that it's interesting. So I had an inquiry recently where they husband and wife team, they're doing a fantastic amount going forward. Their current accountant does a self-assessment, but didn't reach out to them to understand what they're doing. So in the meantime, they had set up 2 limited companies, started developing an app, which is fantastic. And I think as a company, this is a great idea.
Yeah.
But then their accountants had no idea about this. So as the year had gone on,
things had changed.
Company was, well, exactly. So things had completely changed. So one of the partners decided to, so they operate through a limited company. All his income was going through via the limited company. However, and this sort of dovetails nicely into our next point, is to how you treat the money. But he wasn't following the correct process of how you treat that money going to the limited company, which, because it's in the current tax year, I can unwind, I can fix that. when your tax year closes, it's a bit more difficult to do.
Sure.
So we can unwind. And then just talking to the client, understanding what they were doing, because I like to, I mean, much in the same way sort of you and I were sort of banding around banter before this podcast, is just understanding who you are as a person, because can we work together? I've
Yeah.
said no to people. I've said no to clients who've wanted to join me because I just didn't think we'd have that relationship going forward. So it's worth me understanding. And one of the things that we spoke about was their app, and we realized that, having discussed it back and forth, talking about research and development, they didn't know they were able to get it. I think we're recovering about £19,000.
It's
That they
huge.
didn't know
Yeah.
that. Yeah,
Really, really
and they
big.
didn't know that, and they had no idea that they were entitled to it. They would never have had any idea. So how do you know if your accountant's doing enough? It really goes back to that point there that says, well, you would never have an idea until someone tells you otherwise. So that's some of the things that we get. I think the biggest complaint that we get is communication. That's the single biggest complaint that we get, is communication. Is I don't hear from them. I only hear from them once a year. I don't get a quick enough turnaround when I need some advice. And I think it's comforting for me, because that's the model my practice is built on, is communication.
Yeah.
Is that, look, sometimes we might not be able to give you an answer on a tax question straight away, but we'll go away and find it, and we will come back to you. But the fact that we were here and ready to listen to your query in the first instance is how we work, and there's multiple ways to get a hold of us. So that's some of the biggest. That's some of the biggest. Well, I think that's the single biggest one is communication.
Yeah, and that goes with all business relationships. I mean, you would think, wouldn't it?
Correct.
So, it's funny, all the same things that we talk about when I'm doing a dental podcast, where it's tell the patient X, Y, Z, or just you have to make sure they understand. It's the same things that you're talking about, that you're thinking about for your clients. I'm sure if you deal with someone in a different sphere, then it's the same thing again.
Yeah.
So yeah, limited companies. Guys, by the way, if you're watching, make sure to hit the like button and share to your friends. Really helps us out. How do you get paid when you're setting up a limited company? I think that's the first thing. And maybe talking a little bit about the actual process of setting that up, when to set it up, just so we can walk people through the rationale behind when to do it, and then how to get paid, all those little bits, and we'll tie it up into one neat little box.
Cool. Right. So there's quite a bit to unpick
Yeah.
here then. So
Sorry.
we'll go through sole trader. No, it's cool. I mean, I enjoy these conversations. So the first thing to really unpick is what your default position is always sole trader. So unless you set up a limited company, then you're always a sole trader. So that means you pay tax at the normal income tax bands.
Yeah.
Which is 20% up to 50k, and then up to 150k it's 40%, and then 45% thereafter. One of the benefits of being as a sole trader is it's very easy. All your money is all your money. You get taxed on everything you earn in the year. It's based on the cash basis, so there's very little accounting that happens on the back of it. In that, it's all really straightforward. Things like payroll can people think payroll can only be done through limited companies. It can't. If you're an employer, you can be an employer via a self-employed, limited company, PLC, however you want to be.
Right.
So you can still employ as a sole trader. So you can still do that. And then when you start earning over 100k, so the first £12,500 you earn is tax free.
Yeah, that's your allowance, they call it, isn't it?
Your personal allowance, yeah. However, for every £2 you earn over 100k, you lose £1 of that.
Right.
So once you've got to 125 grand, you've lost your 12.5k personal allowance. So that's cost you £2,500 now. There are ways to mitigate against that, in that if you upped your pension contributions or started putting money into a private pension pot, it takes off that total number. And then some people prefer to stay that way. Some people prefer to stay a sole trader because they want to maximize the pension contributions, and they're happy that the figure's known. They're happy paying the tax on the back of it. It makes things like loan applications, mortgage applications really straightforward, really easy. They've got no aspirations to own their own practices per se. However, I've got practice owners on my books who are sole traders, and they're quite happy to work that way. That works for them.
Yeah.
Why you'd start looking at a limited company now, before we get to the limited company, there's more options that exist other than limited company. Some people think that it is sort of one or the other. So if you're a sole trader, you're a sole trader. Then you can have a partnership.
Yeah.
So partnership is more than one sole traders. Everyone is treated on the partnership agreement. So whatever you set those terms out at the start is what you get your income back on. You've then got limited liability partnerships, which is sort of halfway house between a limited company and a partnership. So a limited liability partnership is a separate legal entity, but it's run by its members. So a limited company is shareholders are run by the directors.
Yeah.
Whereas a limited liability partnership or an LLP is run by its members. So the members are the people that own it and run it, which is why a lot of accountancy practices, law firms, things like that are run by LLPs or are LLPs. Then you've got limited companies. So limited companies is governed by something called the stewardship theory. And I'm not going to get too much into the jargon, but what it says is the people that own the company and the people that run the company are two separate people.
Even if it's the same person, which is where it gets really weird.
It does get really weird. Yeah. So I could own a limited company, so I own 100% of the shares in the company, and I'm the director of that company. So I run that company as well. Now I could step back and appoint you as the director of my business, but as the shareholder, I still get the profit after taxes paid. So the dividends. So the dividends still come to me. You as a director would then get paid a salary to run my business, which is where the key difference is between a limited company and an LLP. Beyond that, you've got a PLC. So a PLC is where the shares are traded on the open market, but it's the same principle as a limited company. So the shareholders own the business, and then the directors run the business. Now, with a PLC and a limited company, you are governed by the Companies Act 2006. I hope I've got that right.
Yeah.
Which really states, and this is where I drill this point home, is you cannot treat the money of the limited company like it's your own. You just can't do it. So you can't use the company card for petrol, for purchasing petrol or anything like that. So if you're ever audited and they look at the limited company and say, this is just a limited company by name, it doesn't do anything, they call it pulling down the veil. So pulling down the corporate veil, which is to say, does it pass a couple of tests? If it fails those tests, then we're going to tax you as if you were a sole trader. So you've had zero benefit from running it through a limited company. So there are some specific rules. Now that sort of takes us into the how do I get paid as a limited company? Now, when we go back to the point that a limited company is different to, so the owners of the company are different to people that run it. As a director, you're entitled to a salary.
Yeah.
So we put through a tax advantageous amount. I'm not going to say what that is because why give away all the secrets? But so again, Companies Act, you are required. So if people are paid regular amounts at regular intervals, you are required to run payroll. Payroll is a monthly submission to HMRC.
Yeah.
And that's PAYE. So what you would have been on before in your foundation year before you went as an associate. So you get your pay slips. So you've got to produce pay slips, so on and so forth. Right. So that's the first way you get the money out of the business, through your salary.
Yeah.
Now the second way is dividends. Now dividends are what you as a shareholder would get once you paid tax on all the profits. So let's say, for instance, you've turned over £90,000. You've had £30,000 worth of expenses. You're left with £60,000 worth of profit.
Yep.
You pay corporation tax at 19%.
Is that 41?
Which, yep. He says. So you pay 11,400 of corporation tax. Times 0.81 gives you 48,600. Once you've paid your 48,600, so that's what's left in the business now.
Yeah.
So at this point, you have options. So how that money comes to you is as a dividend. So bearing in mind, the company's just paid corporation tax. The company's just paid corporation tax at 19% on the profit after expenses. Now your salary is classed as an expense in the business.
Yeah.
So you've already had a sum of money come to you. Now the rest of that money is up to you. Now let's say you then decide to take all that money out as a dividend. Dividend, you take it all out. Correct. So the first £2,000 are tax free.
Yeah.
Then up to £50,000, you're taxed at 7.5%. Over £50,000, you're taxed at 32.5%, which is a whopping great chunk of money. Now, when you factor it in over £50,000, you've paid 19% corporation tax, and then you've paid 32.5% dividend tax.
Yeah.
And then you're thinking, well, as a sole trader, I would have only paid 42%, which is 40% tax and then 2% national insurance. I'm ignoring student loan at this point.
Yeah, because some people have it, some people don't. Yeah.
Correct. So this is where hybrid positions become a bit bit weird, and we'll go to that in a second. So that's the second way you get the money out of the business, is a dividend. Now, people think you can only declare a dividend at the end of the month or at the end of the year or once a year. No, you can declare a dividend whenever there's profit in the business. So going back to how we work, we do your accounts through the year, so you always know what your profit after tax number is.
Yeah.
Because as long as you're putting your expenses on weekly, monthly, however you're doing it, you know what the revenue number is, you know what your expenses are, you know what the profit is, you know what the tax is. Therefore, that number at the bottom is then what you can start taking out. Yeah. And you can take that as many times as you want, but there is a procedure that has to be followed. So you have to have something called a dividend voucher. So a dividend voucher is something that we'd create that you put on file. So much in the same way at the end of the year, you get P60.
Yeah.
We would look at your P60, your dividend vouchers, and that makes it your self-assessment. So, and the third way to get money out of the business is expenses. So any expenses that you've paid at your own pocket, you raise an expense in the business, and again, our software deals with all that.
So you paying the expenses from your own personal card or whatever it might be, and then the receipt goes to the limited company, and then you get something deducted. Is that how it works?
Correct. So you get the cash back at that. The biggest one is mileage.
Yeah.
So we'll go to company cars in a sec, and please remind me. But so if you're going and doing work-related mileage, now you can't claim to a regular place of work, but you can claim everywhere thereafter. So let's say you're going to drive down to Birmingham for an exhibition.
Yeah.
You claim 45 pence a mile for the first 10,000 miles, and then for anything thereafter, you claim 25p a mile. So you'd claim that back as an expense. So if you've done 10,000 work-related mileage, you claim £4,500 back from the business.
On that, how do we work out how much has been done, or do you have to mark it down every time you go somewhere, almost with an evidence sort?
So you've got to mark it down. So again, our software deals with that. So on the app itself, you put in the mileage point to point, where you went, where from, where to, and then the return journey, and then things like any incidental costs along the way. But it's called simplified expenses. So HMRC really allows you to do certain things in very easy ways.
Yeah.
Now, mileage being one of them, they call it simplified expenses. So it's saying as long as you can evidence, if ever called upon, that you've done that journey. So we'd have to keep a record of it somewhere. But again, the expense claim's there. So what I would do, and the way I do it, is I keep a diary of says why was I there, but I then put detailed notes on the software that says I went to see Jabir in Scunthorpe.
Yeah, Halifax.
Don't know why you're in Scunthorpe.
Thankfully, I'm not in Scunthorpe.
I didn't want to bay out where you lived. So
I think everyone knows. You can just look on my page. You can see the tags for location.
So I take GDPR very seriously.
How many? But you got a question? How many copies can you claim?
Good one. So I've got an espresso machine in my office, and I've got an espresso subscription, which is paid for by the office. So things like staff refreshments and basic refreshments, so tea, coffee, things like that are expensible. So how many coffees can you claim? And I like this one because I've got one client who I think has a genuine problem. As long as you're not traveling to one place of work and you're traveling out on the road and you're away from home, then you can claim that as part of your lunch allowance.
Yeah.
But it's generally sort of £5 for lunch, and then if you're any overnight stays, you can claim sort of £25 for dinner.
So, that's not a lot, actually, is it? You're not.
No, it's not. But it depends on the policies and stuff. So there's sort of ways and means.
Because I'm thinking steak dinners, and maybe something a bit fancier for lunch if you're claiming expenses on it. But if there's ways around it, then so be it. So then you need to have some sort of reason why you've gone there, and you're going to put that on the app, so then you can work it out, or you've got to mark it down. With a lot of payments being digital these days, do we need physical receipts, or how does that work?
So if you're raising an expense that hasn't come out of the business's bank account, then yes, you got to take a picture of the receipt. And again, software, just take a picture of it in the receipt. If it's digital and it comes through on your business bank account and it's clearly marked as what it is, then that's fine. I mean, things like cost is obviously going to be cost.
Yeah.
But whereas if you said you went to IKEA and the bank transaction just shows IKEA, but you went and bought office furniture, I would then need you to just on the bank transaction, you can then add a picture of what you've actually bought.
Okay, so a picture of the item or a receipt as well.
Receipt, yeah, just a receipt that says this is what I bought, and this is what the expense is for. But I then reach out to you for that says, or a member of my team does, that says, we review the transactions, we allocate them. So it's the basic bookkeeping. So we do that. And if something that I don't like the look of, put it to one side and I give you a nudge and say, Jamil, what's this for?
Yeah.
You will then tell me what it's for, and then I would say, well, I probably need a receipt for that. So just show me the receipt, and I can just tag it on, or you can tag it on, and then we forget about it. The reason for this is if you're ever audited by HMRC, they can look back at
You
any
just
time
hand it
frame.
to them.
So normally, you just hand it to them. Yeah, we just give them access to our systems that say this is exactly what's happened. They'll spot check some transactions, and they'll leave us alone.
Have there been
and that's the way we
have
work.
there been issues this year with COVID in some certain places maybe not giving receipts? I don't know if that's been a thing or not. I've barely been out of the house.
No, not that I
Been
know
okay.
of.
All right. That pointless question
okay.
there.
Yeah, but I think to be fair, some are emailing it. So instead of handing over a physical receipt, depending on where, I can't remember where I went. I think I was buying something for the house, and they emailed me my receipt over. That said, Wix actually, yeah, that said we'll just email you a copy of the receipt, so it's there. It's actually really useful, actually. So
I would prefer
so
that. You know, if you're getting a contactless payment, surely they could contactlessly give you a receipt or something. That would be brilliant.
Yeah, no, that'd be useful.
Just while you're
they've got
NFC
all
in
the
it, you
details of
know,
the transaction there.
that
Makes sense.
exchange. I don't know. Save the trees, eh?
Good idea. Yeah, maybe Lannister can deal with that. There was a big advertising scheme on the new banking app, Lannister. Maybe they can deal with that.
Yeah, well, let's see. If not, I'm claiming, you know, let's mark the date down. If someone else comes out with that idea, I am, you know, claim that I thought of it first. Implications of the limited company: you lose your NHS pension.
Correct. So I get interesting questions on this. Now, a lot of it is hearsay. So maybe people that have been in the industry for a while will say the new scheme's terrible, so on and so forth. It's not. It's actually fantastic. It's a great pension scheme. Pensions aren't for everyone, though. From an accountant's perspective, it's regulated advice, so we can't step into that territory that says this is what you can and can't do with it. We give you the options that says we'll put you in touch with the right people that says you know, if you want to look at private pensions, speak to these guys, or find your own people. That's completely fine. But the NHS pension scheme is fantastic. The maternity scheme is fantastic.
Yeah.
There's nothing to say you can't opt in and out of the NHS pension scheme, and certainly for maternity benefit, as long as you're opted in before you're pregnant, then you're completely fine. Now, with regards to pensions, so if you were going to earn, and I base it on £50,000 because that's the threshold.
Yeah.
Before tax starts going in different directions, is if we just base it on £50,000 profit after expenses, you would save about £3,500 operating through a limited company.
Yeah.
Now, that's just like for like £50,000 expenses are the same, and that gets you to sort of £3,500 worth of saving ish. However, if you were to then invest in a private pension pot, that money is then deemed an expense by the business. So if I contribute to my employee's pension of 10%, that's classed as an expense. If I then match that at 10%, that number gets deducted from my taxable income. So let's say, for instance, I contributed £5,000 to that pot. My employer contributed 10% into that pot. So that's 5,000. They put in 5,000, I put in, and my net income comes back to 60K. Well, you take that 10 grand off. Or in this 50K example, you take the 10 grand off and you run it on the £40,000.
So is that for the company's accounts?
Yeah. So if you own the limited company, then you get the benefit on that as well. So this is if you were going to operate your own pension scheme. So it's worth doing. So if you were going to opt out of the NHS pension scheme, operate through a limited company to get the tax saving, I would always insist on you going to speak to a financial consultant or financial advisor about setting your own private pension pot up, because low risk pots, there's high risk. There's so many different things that you could do depending on your own risk profile. That says, so I would urge you to do that regardless, and it's worth doing. Where you get hybrid solutions, so some people operate all their NHS income through sole trader because they want to maximize the NHS pension, and then they put all their private income through a limited company. Now, this is where it gets really interesting. So one of the I like getting the question that says, can you save me more tax than my current accountant? Well, I can't answer that question, because if you've earned £50,000 more than last year, then you're going to pay more tax. And then that's and I like seeing that says, I'm paying more tax than I did last year, but you've earned £30,000 more. So proportionately you've paid. It's not just sort of double or proportionately goes up. There's still some savings to make and things like that. That says tax is a proportion of your profit. So it's always going to be 19% of your profit after expenses. So if you've earned more money, if you made more profit, then you're going to pay more tax.
Unfortunately, yeah.
Unfortunately, yeah, but it's what we do with that number thereafter. So we go through sort of a hybrid option now. If in the example that we spoke about previously, where you pay 19% corporation tax and then 32.5% dividend tax after £50,000, if you didn't need that money, you would leave that money within the business.
Yeah.
That gives you options to do a couple of things. So one of the things I always want to do right at the start of getting to know my customer or my client or people who join us is, what are you hoping to achieve? What do you want to get out of it? What is your short, medium, long-term goals? And sometimes it will help you develop that. And I'll go through that when we talk about success factors. But I want to understand what you're trying to achieve, and that way I can advise you on the best solution. Because if your money is just to maximize all your money to come out your business, then a hybrid solution is horrible for you, because if you can take it all out, you're just paying too much tax. If your option is to take out as much money as you can and do it in the least amount possible, you don't care about the pension scheme, and go through a limited company. Yeah. If you want the pension scheme and you're earning over sort of £60,000 NHS income, then don't bother with a limited company at all. Because if you want all the money to come to you at the end of it, then you're going to pay too much tax within that. And that's actually a detriment to me, because I get more fees if you do a hybrid solution, because I charge you for your self-assessment and I charge for limited company. Yeah. However, I would rather a relationship for the next 30, 40, 50 years and not so much about today.
Yeah.
So I always want to understand what you're trying to achieve. So where a hybrid solution is quite viable is if you plan on doing something with that money that's sat in the limited company. Let's say, for instance, you want to buy a practice down the line, or you want to invest in other businesses, or you want to buy property. I'm not going to go too much in property, because I think
we're gonna do that at some point as well. Yeah.
Yeah, and then, but what you can do is then use that money to invest in property within the limited company. So there's massive tax advantages to do that. So again, if you're earning over sort of £60,000 or anything, a penny over £50,000, and you've got a rental property in your own name, move it over to a limited company, because you're just paying too much tax.
Yeah.
So that's really the crux of that final bit. And then really is, if you want to operate as a limited company, yes, you'll save money, because there's other tax advantages. So right on, if we just talk about £50,000, is you'll save £3,500 in tax. However, if you then took an electric car out,
it's 1% this year, is it? It was 0% last year, I think. Was it 0% this year? I can't remember.
Yeah. So 0% up to April, and then 1% up to 2022, 2% thereafter, until the government change it. Now, you save a phenomenal amount of money. So one of my friends, we were talking about cars, and he went and got himself the Model 3 Performance, and we worked out that after tax, it's the same as if he had got a 320 diesel. So he saves about £3,500 a year in tax.
Just so hold on. So a Model 3 Performance costs you. Hold on, I'm getting Auto Trader up right now. 1 second.
Well, we've got to do it on lease. Oh,
is it lease deals? So right. So it's not buying.
Lease deals, yeah. No, so when you buy it, the tax works out slightly differently. So you treat the asset slightly different. But if we just talk about leases,
okay, right. So I won't
because when you lease a vehicle, you can expense the whole. If you lease an electric vehicle, you can expense the whole amount.
Okay.
Now, so when we get asked, when we say expense, we mean that's the number that reduces your profit. So you can put the whole thing through. So for an electric car, you put the whole amount through. So the cost of the insurance, the cost of the charger, the cost of the vehicle, everything. So the lease payment, that you put through. You've got to spread the deposit over the life of it. So if it's a 3-year lease, you can't put all deposit through in the year. In the first year, you just spread that amount. Yeah, you spread that amount. If it's 3-year lease, you spread it over 3 years. But ultimately, that reduces your tax bill. Now, if you look at it the other way, if you're going to get, I don't know, let's say you're going to pay for it out of your own pocket, you would have had to have paid 19% corporation tax, 32.5% dividend tax, to then have the money left over to go buy the vehicle. Now, the wife and I were joking about a Porsche Taycan, and the lease payments on a Taycan are about I think £1,000 a month.
What is it, 182 grand to buy that thing outright?
No, it's a lot less than that. I think not that's the Turbo S. I'm talking about.
Just a standard model.
The bread and butter one. just a standard one that still does it in 3 seconds. That'll still knock the hair off my head. But I think we worked out that paying £1,000 a month was the equivalent of paying all the associated taxes and then being left with £557 to then go spend on the car.
Wow.
So, in essence, if you look at it from a like for like perspective, yes, you're spending £1,000 a month, but it's as if you had paid £557
a month.
Now,
okay,
yeah, and it's still obscene amounts of money for a car.
Yeah, but if you're gonna try to avoid tax and you need a car, then that's probably the way to do it.
Correct. And then the reason why you don't do a non-electric car, or the hybrid still having a tax advantage, but if you're going to do let's say a gas guzzler, what you end up paying is the lease costs, and then there's a predetermined value of a car, so it's called the P11D value. So whenever you're looking at a brochure and you get down to the prices, it shows you the benefit in kind, so the BIK, that's how much tax you would pay, and then you've got P11D. So let's say, for instance, you go to B&W, you negotiate the sale of you purchase of a car. You get an absolute cracking deal. It's 20% on the list, and you think that's what you value the car at when you look at the company car tax. That the figure that you pay for it is irrelevant. It's the P11D value, and that value is preset. So they say this is what the car's worth. This is what the car is. We'll then charge a percentage on that car. So let's say it's a gas guzzler. Let's say we're going to charge you 19% of the value of the car, and then you get taxed at your tax rate, which will either be 20% or 40%.
Let's have a look at one of the examples actually. So let's just find. Right, Range Rover. Okay, let's go with one of those. Do I just have to click on one of these? Let's have a look. And this is a VLAR. So P11D is 24,500. So you'd be paying.
So say that number again.
P11D is 24,500, and that's for a Range Rover VLAR. It's one of, I don't know how good that is or not, but I think that's a pretty expensive car, isn't it? 70 grand.
Yeah, so that's the amount that after they've taken the deduction on that, and then depending on your tax rate, you either pay £4,900 a year if you're a 20% taxpayer, or if you're a 40% taxpayer,
10,000.
Double that. Yeah. But so it's not worth it because you paid for the lease payments on the car, and then you're paying for the tax on the car, so it's absolutely not worth it. Whereas if you do an electric car, it's phenomenally tax effective, and these are the sorts of expenses now. I get asked all the time, can I claim uniforms as expenses? Now, for dentistry, it's dead straightforward. Scrubs, absolutely, yes. Work coats, absolutely, yes. Where the HMRC rules come into play is when we look at uniforms, there's a couple of categories. PPE, absolutely, yes, you can claim all that. If it's a costume, yes,
scrubs.
But that doesn't apply to dentists.
So does it's not? So scrubs are on there, or no?
No, scrubs are absolutely on there, but I'm talking about like any sort of costume that you'd wear. So unless you were a kiddies entertainer that you were going to make it really interesting for the kids and wear a clown uniform on top of your scrubs, then yes, you could claim that. The biggest one, and again, I'm doing it here, #branded, is anything with an embroidered logo on there. So what they generally tend to say is if you could wear it outside of work, then you can't claim it as an expense. Whereas if it's embroidered with the company's logo on there, you can claim it. If it's PPE or if it's costume, then you can.
So claim it. I mean, I see some people who are in the more high-end private clinics wearing suits for checkups or for initial patient exams. When they're just having a chat to them and stuff like that. And you couldn't do that unless you'd maybe put your logo on the pocket of the thing. Then.
Correct, and it would have to be embroidered.
Right.
So you couldn't. It couldn't be easily removable. So a friend of mine asked if he could claim his Tom Ford suit as an expense as well. If you fancy putting your business logo on your Tom Ford suit, then yes.
How big does it have to be? Is there a size requirement for that?
Not a size. It just has to be embroidered.
Just on the sleeve underneath.
But I think it has to be prominent. But I'd have to go away and check because I don't think.
I'm coming at you with some left field suggestions here. Can we put it inside the collar?
No, it has to be visible. I'm afraid it has to be. Yeah, generally when you get things embroidered, it's sort of a 8x8 on the breast or somewhere on the side. Some are prominent. But I think generally that's the way it's got to work.
I'm sure you could get a suit looking good with a black and white logo if it was a black suit. I'm sure you could work away. I'm sure you could get away with that.
Well, I'm gonna work it out somehow. So some people think putting their name against it, but if your business name was your company name, then nothing to say you couldn't do that. Monogram's never going to work unless your company was monogrammed. Yeah. But yeah, so generally that's the sort of thing that you can claim for. One I get asked quite a lot is lab fees.
Okay, yeah, really good one.
No, so we talk about limited companies and sole traders. So there is a key distinction here. So for sole trader, you can do something called cash accounting. Now, cash accounting generally is exactly that: is how much cash did I incur or come in and out my business up until the 31st of March or the 5th of April, depending on when you want to set your books to, because there is some grace. Is what cash came in. Now, generally, as an associate, when your money comes in, it's net. It's
Already deducted,
it's not
isn't it?
gross. It's net. Correct. So your lab fees are deducted. Your commission split, technically, what you're giving back to the practice has been deducted. So that's what you've earned. So you then can't then claim lab fees on top of
Right.
that. So technically, yes, you can absolutely claim lab fees. However, the money you've received already has that deduction in there.
So it's already been taken care of there.
Correct. However, when it comes to a limited company perspective, now again goes back to so the money you've earned as an individual contractor is actually the gross number. So I go out and do a treatment that's £4,000, but you give me £2,000, which is my 50-50 split, and then you take out the lab fees and everything out of that. I'm left with, let's say, 1750.
Okay.
But I've not actually earned 1750. I've earned £4,000. So the way I record that in the books is the top line number is £4,000. I've then incurred £2,000 in commission, which is the split to the referral fee, no matter whatever you want to call it. And then the lab fees I can claim there. The number is going to equal the same amount that you've had come in from the cash from the cash that's hit your account. So the number will be equal. However, that actually helps you in the long term. So you're not going to pay any more tax. People think, oh my God, he's put 4,000. No, the net number is still the same. However, it actually really helps your position when you want to go get a bank loan to buy your own practice. Now, if you're an associate that's been earning £100,000 a year for the last 3 years, you go to the bank and say, look, I've been earning £100,000 for the last 3 years. They'll say yes. However, you've not been earning £100,000 for the last 3 years per year. You've been earning £200,000 a year per year for the last 3 years. What you've actually been doing is giving away £100,000. Now, if I'm the bank and I'm thinking, hold on, you're right, because you're no longer going to have to give that £100,000 away. You're much lower risk to me now.
Yeah.
So your lab fees obviously increase because you're now paying 100% of the lab fees, but now you're giving no referral commission away. Now, Invisalign is a fantastic example of that, where you can charge £4,000 a treatment for top for both arches, but you then walk away with, say, £1,500 of that, because once you've paid all the lab fees and so on and so forth, but you've actually correct, depending on how you negotiate your split, so on and so forth. But we'll go with half because it's an easy number. But you've actually made £4,000 because you've sold that treatment. Now, if you're very active on social media and you bring in your own clients and your goal is to open your own squat practice, then it's going to be really easy for you to get bank financing. And now this is where bank financing comes into it. Now, depending on your risk profile, they might say you've got to put 20% in, you've got to put 5% in, you've got to put 10% in, you've got to put 30% in. But again, your risk profile is you go back and say, well, I'm asking for half of the money I actually make, so I need £100,000 to set my own squat practice. But I've been consistently earning £250,000 for the last 3 years per year. You're now very low risk to them, and in some cases, they will just loan you that with none of your own money up front. Wow. So this is where we work with you on this, and this is where we provide our value, because I'm a big believer of any qualified accountant will be able to do your accounts. And when I say do your accounts, I mean get to the end of the year and tell you what's happened, but it's already happened at that point. I can't add any value. So how do I add value to your business and actually get you to the point where? Correct. I mean, I joke with one of my friends. We were talking. We were cycling at the start of the year, and we went up driving somewhere to go get a bike, and we were talking about cars and stuff. I'm massively into my cars, and he was talking about a Lamborghini Urus, and I was like, well, let's talk about Lamborghini Urus, because I like to understand. It doesn't make him tick because he's not that way inclined. He just likes the car, and he's a family man and he's got sort of bigger priorities. But I said, look, let's use that as an example. So what does a Urus cost? Now I've done a quick lease check that said a Lamborghini Urus with minimal deposit would cost you 2.8k a month.
Oh my God, yeah, crazy.
Now, well, is it? That's two Invisalign cases a year, a month as an associate. Now, is it crazy when you put it like that?
Yeah, I mean, you could do it. You could say it in when you put it out like that, and if you're in the right job, then maybe it's not, and then it depends what you want to do with your money, isn't it?
Correct.
That's
correct.
That's one of the things we were going to get onto in a bit, wasn't it?
Yeah, and that's what I talk about, success factors. That says, well, what do you want to talk about? And before we jump onto that, I'll hand back to you at this point. It says, do you want to? Have we missed anything, or has anybody asked us anything?
No questions since the coffee comment. Let me check Instagram, see if there's been any on there. I put it up really late because I was a little busy with this whole delivery thing. But
well, I think before we do that, then, so I'll go through a worked
yeah, go
example
for it.
of a hybrid solution, where on this basis, because we've been talking about £50,000 now. Look, let's be realistic. Most associates outside of COVID will earn more than that. So I've got an example here that I've knocked up on £90,000 that said, again, we're talking cash accounting at this point. That says lab fees and everything paid, what's actually hit the account. So we'll talk gross numbers. So as a sole trader, you've earned £90,000. You've incurred £35,000 worth of expenses. Your total taxable income is £55,000, and none of this includes student
Yeah,
loan, by the way. You'd pay £13,300 as tax as a sole trader. So you'd walk away with
36,500 is it? 700.
41,695.
I'm so bad at maths, thinking off the top of my head now.
That's twice now. That's why I don't do it.
I used to be so good at it. Honestly, it's been a while since I've done any maths. Yeah.
No, good man. So and so 13.3k in tax you would have paid as a sole trader on £90,000, having incurred £35,000 worth of expenses. Now we'll talk. Do you want a limited company or hybrid?
So let's
You pick.
see. We've talked about setting up the company and how to get paid from it. We've talked about the implications of doing that with the pension, all that. We talked a bit about how much we can save, haven't we?
Yeah. Well, we're going to go into that
in a bit more detail.
With some more.
Yeah. So we've done company cars as well, which we were going to talk about. A couple of bits we've got left is a bit more on how much you can save. Earning over 100k as a sole trader, we didn't really dive in on that, did we?
Well, I think the only implication on that is you're going to pay more tax regardless, but then it's that every £2 you earn over, you lose your £1 personal allowance. So when you're factoring in your tax equation, it's not just 40% or 42% on anything over 50k. You've then got to factor in, once you've got to 125k, you then add another £2.5 to your tax bill.
Okay. Then we've got hybrid options, business expenses for the last couple of points, and then we were going on to slightly more ethereal topics, weren't we?
Yeah. So, well, let's do this hybrid option then. So it's a bit more detail. We'll talk about £90,000. So, as a sole trader, you'll pay 13.3k tax, and again, ignoring student loan for this. In a limited company option, you would pay. So your cash saving is £8,064. So you walk away with more money, basically. So you pay considerably less tax on that. So you walk away with more money. So where have I got this? So just give me a second to make sure I've got this.
How much were we grossing in that first amount? How much were we technically earning? So we can do the differential between the two.
Yeah, sorry, just give me a second. Just make sure I've got this.
Guys, make sure to get your comments in if you've got any questions about anything we've been talking about, anything tax related in the UK. Make sure to like the video. There's loads of you watching. We could definitely do a few more likes, and make sure to share to any other dental friends or people who are interested in finance and tax efficiency and all that kind of stuff, because I'm sure it'll help them as well, and it certainly helps me out with subscribers and stuff like that. Have you found your numbers yet?
Yeah, so I've got it here. So when we're talking about £90,000 on a limited co, you're saving about £4,000. And then the differential between a hybrid and a limited co isn't that much. You're probably saving about £1,000. So this is assuming you took it all out. So it's whether what you're trying to do with that money thereafter. Right. So we go through some specific examples. So I think throwing numbers out there is a bit generic. I mean, I had a question once that said, how much tax should I pay on £60,000 worth of income? But without knowing your expenses, I can't tell you that number.
Yeah.
So it'd be worth knowing. So if anyone wants to know, I'd happily run through an example with you that said, what are your options? What could you save between the two? But ultimately, where the saving comes from a limited company is you're paying corporation tax at 19%. But what you're not paying is any national insurance. That's where the saving really comes from. Is there's no national insurance to pay because all the income brackets and we put you up keeps you under the national insurance bandings. The way we set our salary band is you always want to pay a little bit of national insurance.
Okay.
Reason why you want to pay a little bit of national insurance is when you get to pensionable age, they'll look at if you've made enough qualifying payments throughout your lifetime. If you just take, and it's the sake of 140 quid. So we work that into the salary equation that says we'll set your salary at such an amount that you're paying about £140 national insurance, because that then ticks off that year that says you made the qualifying contributions to that year, because you'll thank me in 60 years. Well, when you get to 67, you get your state pension. So, and you're not going to miss 140 quid in the grand scheme of things, are you?
Yeah.
So that's how we work that. So shall we jump onto any of the
We've got
topics?
there was one thing I wanted to ask. When we're talking about pensions,
Yeah, sure.
I don't know if we talked about it last time, but ISAs, is that something that's within your wheelhouse, or is that outside?
No, it's outside the wheelhouse, I'm afraid. So anything that looks like a regulated product, I think banking really, I wouldn't get involved
Yeah.
in. I can advise you on what the implications are, but without knowing what the product is, what you're trying to do with it, so on and so forth. Yeah, it's a tough one to get into without recommending the right product. But yeah, so I've just seen one comment that says, "What are Heathrow Green's fees?"
On that.
Depends on what you want from us. So drop me a message on Instagram. So the handle is at Heathrow Green.
See it on screen.
Drop me a message. Yeah. Oh, there it is. Yeah, perfect. So drop me a message, and depends on what you're looking for, what you're trying to get, what you get at, what your setup is. So we look after sort of sole trader associates that are sort of fresh out into the environment, and we've got multi-site practices that we deal with, and partnerships are more complex with more going on. Obviously, the fees change depending on what it is you need from us.
Let me know in the comments if you want us to do something around practice ownership and practice finances. I think that might be an interesting one, which is a little bit different to what we've been talking about now, which is more of an associate slash, on a personal side, isn't it?
Yeah, so we do quite a bit of that. So again, the way we work is we're recognised by NatWest. So when we send a set of accounts to NatWest, they know who we are. So there's a lot of confidence in the numbers we produce on the back of that, and with Lloyd's. So when it comes to practice purchase, there's two sides that we can work on. Is A, valuing your business in the first stage that says what's the right amount to sell your business for, and the second one is verifying the asset value of the practice you're trying to buy. So we'll touch on this very quickly. So when you're buying a practice, there's a couple of ways to look at it. So if you've heard the term goodwill used before, goodwill is generally the term is the difference between what you're asking for and what the combination of all the assets are worth. So let's say you've got an NHS contract of £500,000 a year, you've got a building worth £250,000, and you're asking for £1 million. Well, the value of all the assets within that is £750,000, and then the difference that you're asking for on top of that is 250 grand, which is the goodwill.
Right.
And that's generally the point where the bank, depending on how much that goodwill is, that's where the bank will then ask you to put some towards that number, because they're happy about the NHS contract, they're happy with the fact that they can value the building. That's the bit that they're generally unsure on. What we do within that is we'll look at the company's accounts over a period that says, because look, everyone's going to do it. When you come to sell your business, your account's going to look the best they can possibly look, because you're going to show the most EBIT. Now, EBIT is earning before interest and tax, and that's generally the number everyone looks at. Is you then strip it back that says, well, your staff costs were 200 grand more over the last 2 years. Why the decrease? Well, what you'll find is the owner's not taking any money out of the business for the last 2 years because he knew he was going to sell it. So yeah, so that's how you work that number out backwards, and that's what we provide on that basis that says we'll because we look at it with cold dead eyes that says we are not emotionally invested.
Yeah, because it's not your practice that you're going to, or practice that you're going to be involved in. It's just, all right, yeah, we're looking at these numbers. What's going on?
Correct, and numbers don't lie on the back of it. So we unpick all of that, and then we give some assurance that says we think the business is worth this. If you want to overpay for it, that's up to you, because if you can see, but we go one step further and we talk about, well, there's administration expense within this business that you don't really, we can strip that out because you've really got the back office set up within your other practices. We can absorb all of that. So although it's showing a 50,000 expense now, we're not going to incur that going forward. So we sort of factor that in. So it's not just a case of this is what the numbers say, this is what it's worth. It's then looking at it one step further that says, so we look at it with cold dead eyes first to say, well, does it smell right? Then after that is where's the opportunity beyond that.
Yeah, and
but we can go into that in a bit
yeah,
more detail
I
at a
think
later
that's
date.
a whole topic on its own. And you do you
Oh
deal
yeah,
with practices, people who own a practice and looking at the
yeah,
practice's finances on a yearly basis as opposed to
correct.
buying and selling them?
Correct. So this is where the latter conversation comes in, because I think I tried to instill that same mentality, because what you find is people who own multiple practices are more
Mm,
entrepreneurial. Because they're more entrepreneurial, they ask more questions, they want more from you, which says, well, this is why they are the way they are. This is why they've achieved this level of success, is because they've gone out and taken that risk in the first instance. And they want to know more. So we offer a different level of service for our practice owner clients. So it's you get financial accounting, which is your tax returns and your bookkeeping. Then you've got something called management accounting, which management accounting is looking at the business and working with the management team that says, well, if you did this would yield X result. And again, cold dead eyes that says, well, this is how much your earnings per hour are. Is that commensurate to what you're achieving? If practice A is doing more, why is practice A doing more? So uncovering
mm.
that says, why are they able to charge higher fees? Is it down to demographic? Is it down to the location? Is it down to the skill of the actual associate that says, well, if you spent 10 grand worth of training on the associate to charge more money, you'd get that return back in 2 months. And we go into that level of detail with our practice clients that say, because it's a different level of conversation where it's more proactive.
Yeah, yeah. There's a lot more planning involved if you're in charge of the whole building and everything going on within it. So
Yeah,
that's again a different conversation. But I think we'll definitely come on to that as well. I think we're getting a few in the series going to
yeah,
build up, aren't we? Um, how
yeah.
much can we save then? So that was the last kind of big topic we wanted to unpick, wasn't it?
So, I mean, tax avoidance is
Yeah,
illegal. Um, Tax planning is what this country is built on, and that's what the entire system is about. What can you save now? What can you save? And I like this. I like this question because people will start off by saying, "I want to pay the least amount of tax possible." Right? We can be really aggressive. Now, when we get really aggressive, I want you to document every single receipt, every thing you've bought. Make sure everything's you dotted every single I, you crossed every single T, because when you get really aggressive, you start falling within the sort of the boundaries of the algorithm that HMRC
they want to
uses.
see stuff.
You will get
Mm.
exactly, you will get audited. Now that's okay, because we do everything beyond reproach. So we just need to make sure that we've done everything beyond reproach. Is we don't want to work out what happened sort of 3 years ago on a cold Tuesday when we're trying to work out your taxes. So we keep very detailed records of that. Now that can have a detrimental effect, a very detrimental effect. So if you wanted to pay the least amount of tax possible, but also then go get a mortgage of X amount of money, which you can no longer get, because by being really aggressive on your tax planning, you've not had the commensurate income that you would require for that mortgage,
Right.
if that makes sense. So let's say, let's throw some simple numbers out there. Let's say you wanted a £600,000 house. For that, your self-assessment would need to show £120,000 worth of income, but you've been really aggressive on what you've done, people on the payroll, so on and so forth. You've got £50,000 on there, but you're never going to get that mortgage now. So it's how can I save on taxes? Well, what I say is I can't guarantee you'll pay the least amount of tax, but you'll pay the right amount of tax. And now that right amount of tax is depending on what you're trying
What
to
your
achieve,
goals are, yeah.
and that's exactly. So look, I've had a client recently who joined me and said, Bilal, for the next 3 years, I need to get this much money out of the business. Fine, let's do it. Then I explained to him, this is the impact X, Y, and Z. It's gone completely fine. He's aware of it. He's signed off on it. He knows what it is. And then he said, look, once I've got this money out, I can then go back to rectify my position. I just need this money. Fine, let's work together. And that's really useful for me, because it really helps me understand
Where we're going
him as a
from, yeah.
person. Exactly, and then really, I keep an eye on the tax laws coming up, and what's being discussed in sort of the wider atmosphere or the environment, and then let you know what's coming. That says, well, this is what's coming. These are the things you can do going forward. Um, so that's really the position we're in. Is how much can I save? How long is a piece of string? Because the first question I always ask is, what are you trying to achieve? And that's really important for me, because I don't bill myself as being the cheapest. I'll never bill myself as being the cheapest, because I think we add value, way more value than I think that exists out in sort of
Market.
the
Yeah.
general environment. Yeah, and we specialize in a sector as well. So but what we'll say is we'll always work with you on that. And I think we work in a very specific way, which empowers you as the business owner to make the right decisions. And I think that's our goal. That is our mission statement. Is as long if we've given you all the information to make a decision. Now, what we don't do that's actionable. Me just throwing your accounts back at you is data. Data is useless. So information is something you can action on the back of, and that's what we work on.
Yeah, I think that makes a lot of sense. I mean, you could. I mean, it's like you say. It's down to what you want from your life in the oncoming years. If you've got weddings to pay for, or you've got a house to pay for, whatever it might be, is going to require a different approach, and yeah, you need to plan for it accordingly. We've got a couple of questions there. RAK is asking, how much should we save to buy practice in terms of percentage, if you've got any examples? Maybe very quickly deal with that, and then we'll come back again for a full kind of practice ownership or that kind of a session, because I think that'll be a really good one.
It sounds like a cop out, but it really does depend on your situation. Now,
Yeah.
what I would say is if you had 20% in cash towards the practice you want to buy, you're in a very, very, very good position. Now, what you'll find is when you buy a practice, and this is sort of skipping over to that detail, is if I say to you, Jabir, I'm going to buy your practice for £10,000. Let's use just ridiculous numbers. That doesn't need to be £10,000 today. So that's over a period of time. So let's say, for instance, my initial purchase. So let's say it's £10,000, but to initially get into the business, I need to give you £3,000. So I then pay the remainder of the cash owed to you from the business's revenue. So I'm actually debt leveraging. It's what United. So it's what Glazers did to United.
Yeah, I was gonna say this is out. So actually, it's not just United; it's every single transfer. No one pays cash.
Yeah.
This all amortized over 5 years or whatever it is. And actually, transfer fees are like they're almost a non-event, because it's the accumulation of people's wages over 5 years, which is more of an impact, because you've got a big chunk. I actually did a spreadsheet on who's paying the most wages per minute played. And it's United.
Oh, wow.
Yeah, so I work, because obviously there's people who aren't playing, and I was like, okay, well, we'll work out how much, and it's United by a mile, and it's like if you rectify that, then you'd have a much better off situation. But yeah, I digress. Let's go back to what
well, you've actually hit the nail on the head, because that's insight. You've put insight in there that says what is a KPI, what is a actionable event. So that action, like you said, by bringing that number down, it actually generates true value, because what it suggests is you've got dead wood on your bench that you need to get rid of. But that's the entire United squad at the moment.
We're not that far, actually. I think most of it's gone, I would say.
Yeah.
Jones, Rojo, Romero. Yeah. Okay, then we're looking at pretty much that's everyone gone. And then I'd keep Jesse around because I love the guy. That's the
really.
I like him. I think he's when someone gets it, and if you need someone just to do a job, but I think his confidence is shot to pieces. But that's a whole other topic.
Yeah, well, anything that stops him dancing is like a maniac is useful. So I think could you give examples where? Well, that would be great. So. And again, look, we'll start with the 20% figure. Now, 20% is on the initial amount paid. So you don't. So if you're buying £1 million practice, you don't hand over £1 million. That's normally spread over 3 installments. So let's say it protects you against. Let's say you're buying a really high interest practice. It would protect you in an event in the future if there was any restrictions put on that contract, because the value of the business isn't the same going forward. So that's an example. But they look at, again, what assets the business owns. If it's in a shopping center that all the equipment's leased, the business has no value, you need to put more money up front. If the company owns its own furniture or all its own equipment, owns the building, you're buying the building, then you're less of a risk. But they also look at sometimes you as the person that says, if you've got 3 houses behind you and none of them have got any mortgages on you, they'll just take a charge against those houses that says, if you default against this loan that we're borrowing you to buy to get the business, then we'll fix a charge against your property that says, well, we'll give you 100%, but we'll take a 20% charge against your properties. So on and so. So again, it really is dependent. There are options for people. Now, what I'd say is, don't let a purchase price scare you. I'm always happy to have a conversation. Don't let it, so I work very closely with a brokerage firm, which I think it would be useful if I could get them on, or we get some material for them if we do a detailed topic on that, Jabir. But it's something that we do in detail.
Yeah.
And having worked for worked in the corporate sector where we've bought businesses, I understand the mechanics of how it works very, very well, and again, the accounting of it. So that's something we can talk through in a bit more detail.
Yeah, we'll have a look at that, and I think there's definitely something for us to be done around buying and selling of practices. I think that can almost, if we do start off more general, that can almost kind of be an international sort of thing, and then we'll dial down into the UK specifics as well after in the second half of that podcast, or if we do a two-part jobby. That could be a way to do it. Oh, great question, by the way, from Chris. Christopher Stafford. I'm an FD +1, hoping to move to a salaried role in September. Will Chris have to keep paying the accountant for the fulfillment of the tax return April 22nd?
So, hang on, when's he moved to a salary role in September? April 20, on my tax return, April 22nd.
So it's going to be April to September where he's in a non-salaried role, isn't it? And then he's...
So, yeah, so from the April onwards, so from the April 22nd onwards, you would have to tell HMRC you're no longer self-employed, and it's up to them to decide whether they're going to require you to do a self-assessment. Now, you can do it yourself. It's pretty straightforward. So if you've not got any other income, you log on to Government Gateway. You set up a personal tax account.
April 22. April 22. Sorry.
Yeah.
We got.
Yeah, that's fine. So there'll be no. So the hybrid position is taken out, and then it's that clean year going forward. Where you've got sort of part self-employed, part employed, then yes, you've got to pay your accountant to do your self-assessment because there's still that self-employed bit to deal with. You would have to tell HMRC you're no longer self-employed. They make the decision on whether they want to see one more self-assessment. If that one more self-assessment happens, you could do that yourself. So you register on Government Gateway for a personal tax account. You then, once you're logged on, you can set, it'll tell you whether you need to register for self-assessment or you're required to fulfill your own self-assessment. Yeah. And then when you get your P60 through from your salary job, it's got all the information on there. So you literally just click through. And it is as easy as that. So, and look, genuinely, if you ever get to that position in 2 years' time and you need some help, message me. I will remember, and I won't charge you for that. And that's a promise because it's in the video. It's in the immortal form of video. Yeah. So it's dead straightforward. Yeah. I've got friends that I do it for that I don't charge anything for. But ultimately, it's just the details from your P60. But these are the kinds of things that I think I might do some sort of content around that. You don't have to pay someone to do it. You can just do it yourself. As long as you know what bits of data you're picking up off your P60 and where it all goes onto the Government Gateway, then what it does is it works out how much tax you've paid, and then how much you've earned, how much tax you've paid, and then if you owe any amount thereafter.
Yeah. Hopefully that answers your question, Chris. Or Christopher, I don't know what you prefer. But thank you for that as well. If you've got any more questions in there, guys, please do get them in. And hit like on the video, subscribe if you're new as well. I think that's the majority of the main topics, wasn't it, that we'd kind of earmarked. Did you have some on your story from questions?
Yeah, so R&D was a question I had.
Yeah.
And then one I wanted to go through was success factors. So we'll go through R&D first, and success factors is a pretty straightforward one. You're welcome, Chris, or Christopher, depending on what you prefer. So R&D, so research and development. Now, England wants to be a massive hub for tech innovation. So you might think, how are companies that have never turned a profit or have been making hemorrhaging losses for the last number of however many years able to stay in business? Well, you get something called research and development tax credits. Yeah. Now, which is why things like gaming companies and the like exist within the UK, because it's really tax advantageous to do so. You can claim 130% of the cost incurred. So in broad math, if you've incurred £100,000 of the cost, you can reclaim £130,000.
So you get paid 30 grand to essentially piss away a load of money.
Pretty much. Now, this is where it becomes quite detailed. Yeah. Now we work with a specialist company. Now you can't just claim, say, like Jabir spent 100 grand developing an app. I'm claiming back 130 grand. Doesn't work like that. So you can claim all the time apportioned to developing the app. And the general rule is, when thinking about R&D, think about, does this thing exist in the UK market today? Do the techniques required to build this product exist in the UK today or exist in the market today? So a good example is like body kits. So let's say, for instance, I was going to develop a brand new body kit.
On a car, we're talking now.
For... Okay. Yeah, for a Lamborghini Urus. Now, let's say to develop a body kit for a Lamborghini Urus, no one's going to give me a Lamborghini Urus to strip, are they?
Right.
So I've got to go buy one.
Yeah.
Unfortunately, I've got to go buy a Urus. Done. Woe is me. Now I've got to put it in a wind tunnel to check if my body kit actually works. Now the techniques that I'm going to use, so let's say I'm generating a brand new type of carbon weave that requires me to develop my own oven, my own technique into how that carbon's weaved, so on and so forth. None of these things exist in the market today. If I was going to go buy an oven to bake the kit in, then that oven already existed, so I can't claim that cost.
Right.
But if I have to develop my own oven that's got a bespoke chimney flue that gets to a specific temperature at a specific time to generate the right type of carbon that I'm going to put on this kit, that's all claimable. So you got to think along your entire supply chain that says what here is brand new, that didn't exist until I created it. So that's why it's 1.3%. So it's 130% because it's what you've incurred plus a bit more to keep you going.
Okay. And
it's got to get to the market.
How can that affect dentists then, do you think?
So equipment's probably a good one. So let's talk about an autoclave, for instance. So let's say you created a brand new autoclave that didn't exist in the market previously, that did something that none of the current autoclaves do, that gives you some increased level of hygiene success in half the time, and you've had to create that. Then yes, then that's a kit. Let's say you were going to create a brand new set of scrubs that worked in, that had a synthetic weave in there that was antimicrobial, that meant you could wear it outside of. I'm just sort of
making stuff up.
Loud,
yeah. Essentially, you've got to make something up that could be used in a dental setting that doesn't already.
But it's also got to be feasible in the fact they can get to market. It doesn't have to get to market. It can crash and burn,
right?
But it has to be feasible. It has to have some sort of feasibility to it, and things like that. And let's say, look, you're going to create a new type of chair that didn't exist out in there, but like if you're going to use the existing motors that existed in the market, you couldn't claim that cost. But if you're going to create everything from scratch, if you're going to blue sky and say, I want my motor to look like this, I've got to go engage a manufacturer to go make me a motor that did this. That's the sort of thing you can claim. So it's designed to get people thinking, to get people doing stuff. And that's why things like motorsport is big in the UK, and that's why a lot of them are head office in the UK, is because they can claim this kind of
Formula One, they're all in like Woking and weird places like that, aren't they?
Milton Keynes-ish, around that sort of weird bit between the Midlands and London.
It's all south to
nobody
me.
Ever goes to. Fair enough. But so R&D is an interest one. I enjoy that. So I've worked for companies where I work quite closely with the specialist team that required the information that I needed, and I pulled it all together. They've then done the submissions, and it gave me a massive insight as to the things that you can and can't claim for, what's allowable, what isn't allowable, so on and so forth.
Any money management advice for current dental students? Thank you, Mr. Warlock, for that question.
Message me on Heath or Green, and let's have a chat. Because there's some good ones out there depending on what area of money management you're looking for. If you're looking at how to save for your taxes, there's different things that people do that work, that don't work, when your taxes are due and things like that. Generally about making your own financial situation better or about improving your credit score, again, give me a shout. And again, for what purpose are you trying to manage your money? Is it just to try and maximize how much cash is in the bank? Drop me a message. I'm more than happy to have a chat.
Yeah. Okay, great. Thanks for the question, Mr. Warlock. So yeah, the last thing you wanted to really get into was the motivations behind what you're going to call success, or how that looks like, and Correct. How you can get in the mix there from your side.
Yeah, and I think what we work with companies and people on is success factors. Now, it's sort of a loose term, but I think especially in the current, I mean, I was born in an age pre-social media and pre-sort of internet things, so you got to see people within your sphere alone, whereas people coming through in their sort of early 20s get to see everything from everyone on YouTube, on Instagram, and everything. So success is intrinsic. So some people have a different measurement of success to someone else. So I might have a different version to yourself. Now, what is success? Now, one of the things that I look at with people that are on the cusp of associate or looking at buying a practice is, saying I make 150, 160 grand a year. which is more money than I need as an associate. I'm quite happy doing what I'm doing, and I'll keep doing that. Why do I need the headache of a practice? Well, to that I say, true. If that's what you're happy with, that's fine. But what if you can make 160 grand passively
without touching
and
it?
not having to work? Correct. So now, not only do you have 160,000 pounds of passive income, which isn't unrealistic for a practice owner. Let's be honest, depending on the size of your practice. But if you can make that passively, and you still have the asset, that means when you do come to retire, you can sell that practice and you only pay 10% tax on that.
Yeah.
So now you've been earning 160,000 pounds a year doing nothing. You've then sold your practice, and look, a practice making 160,000 pounds is probably worth 800,000 pounds anyway.
Yeah.
So
is that as an associate-led practice as opposed to associate operated?
Yeah. Associate operated. Yeah. So let's say you get to the end of that, you sold your practice for 900,000 pounds. You pay 10% tax on that. You're left with 810,000 pounds. Yes, it's more work in the short term, but you'll get back to the same net position. But now you're not doing any work.
And you could also still go into work there and get another half on top, or whatever it might be, of the treatment that you would be doing.
Well, surprisingly, I know a practice owner who's got an associate. Well, one of my clients is a practice owner who's got an associate-led practice who then works as a specialist somewhere else. So he's sort of getting the best of both worlds at that point. Because he's got his asset that's making money, and then he's got his specialist or his love or his hobby, the thing that he really enjoys. He's doing it elsewhere, which is making a fantastic sum of money. I think, and that really gets to the crux of what is your goal, success factors. What are you trying to achieve? And one of the things that gets me really on, one of the things I'm used to is, so I've always worked when I worked in corporate, is work with directors. So you set a budget out for the year. Now, their bonuses were based on that budget. So let's say, we're working on a £12 million budget. If they hit that budget, they got a bonus for spending 12 million. Imagine that. Yeah, Jabir, here, spend 12 million pounds. If you spend 12 million pounds, give you a bonus. If you spent less, you didn't get a bigger bonus. If you spent more, then your bonus was reduced.
Okay, so they are trying to keep costs down. So, it's not, please go and spend 12.
No.
Because I can do that pretty easily, don't worry.
So it's hard, yeah. But so what we did was, right. So when you look at your sort of fixed and your overhead costs, so what are my costs? Now, once I know what my costs are, what's my goal for this year? So my goal for this year in this example is to earn, let's say, £110,000. So last year I earned £80,000. I want to earn 30 grand more. Fine. So that's an increase of, I should have just done £100,000. Would have been easier. But let's say you want to increase that. So 30 divided by 110 is an increase of 27.2%, 27.3%. So that's what you want to earn more after expenses. Let's say that's the number. But if you've had to work 50% more hours to achieve that, was it worth it?
Well, it depends on what you would be doing the other 50% of your hours, isn't it?
No, but let's say you've worked, so you were used to working 40 hours a week. You've now had 60. To work 60 hours a week to earn 27% more money.
Well, clearly on a percentage basis, you've done more work for less money there.
Yeah. Correct. And you've sort of I've led you up the garden path there because you're giving the answer that I wanted. So that gets you to the point where that says, well, how do you measure? So if your goal then is to earn £110,000 this year, then surely you want to do it in the same amount of time that you did it last year. So now we can truncate, so we can split your annual hours or what you worked last year, and then divide the £110,000 by that. It says, well, this is your hourly rate. This is what you need to be doing per hour, and that's always in the focus. That's always in the forefront of your mind. That says, well, what do I need to be earning per hour to determine this was a good day, or this was a good week, this was a great week, or if you've not hit that, what do you need to recover the next week? So if you were slightly under and you were at 0.9% of where you should be, then you need to recover at 1.1 or sort of 8% more than what you should have been at that hourly rate. And that really focuses people's attention. That says it focuses your ability to say no to certain types of work, because you might miss that target in the first year. But what you did do is you worked less hours, but you didn't make commensurately less money because you didn't waste time on the jobs that didn't make you more money. And what you'll find is by doing that, you'll actually naturally start moving away from NHS. Because you realize it's an absolute grind and you're just churning out. Look, you can make fantastic sums of money from doing it.
I stopped months ago. I'm still tired.
Well, yeah. But you're absolutely churning it to the point where, look, you can make £10,000-12,000 a month doing it.
Yeah.
But you'll never have the time or the quality of life to spend any of it. Whereas if you start moving away and say, well, if I did £1 a day, then you're probably making more money.
One private crown,
Really,
yeah. Because I mean, how much can
yeah,
you really do NHS in a day? You're probably getting about £350 if you've absolutely caned it, I
yeah,
reckon.
yeah. So and then you're looking at the backache, the physiological impact, the mental impact, and then so this is where we go back to that says, what is your goal? So one of the things that I like to do with the people that are ready for this conversation is we devise a business plan. You might miss it by a country mile in your first year, or you might absolutely smash it in your first 6 months, but then we go back and revisit it. But what the goal is of the business plan is to get down to a couple of key performance indicators, a couple of KPIs that says, forget about everything else. So if the goal is to get the URIS, well, then you need to do two additional Invisalign cases than you were doing to get the URIS.
Yeah.
But you're not getting the URIS until next year. But then what you'll find is by naturally forcing your attention on the Invisalign, your marketing gets better, your focus on the conversation better, your conversion rate gets better. So once you've got the URIS, you're now doing 3, 4, 5 additional cases where you're doing. So now the URIS is actually paid for
Yeah.
itself. So then you get a second one. But it's that kind of thing that says I think this is where I then add value to clients and to people. Is it's not, look, I don't want to go down the life coaching or anything like that, because it's management accounting. It's just a separate side to accounting that people don't know exists. And this is where you start going from earning a good living to focusing your attention on, well, what do I now do with my money? What's worth my time? And that's really it from me at this point. If anyone's got any questions on anything I've asked for, you've got them in the handles down there or down there. Drop me a message. I'm always looking for enjoyable conversations and generally feedback. So if you've enjoyed what you've heard, feel free to reach out and tell me you've enjoyed it, and make sure you follow.
Yeah, absolutely, guys. I think that's we'll call it a day for Bilal, because he's talked a lot today. I've not really talked on that much on this podcast, just been listening a lot. There's been loads of bits and pieces there. Hopefully you guys have picked something up, even if it's something small. I'm sure you picked something up and you'll be able to enact that. If you need any further information, definitely give Bilal a call on his Instagram, or it's mainly Instagram you do, isn't it?
Well, you can call me or email me through it as well.
Okay, perfect. So yeah, and let him know if you came via this podcast. It'd be nice to know what kind of impact we're having here, and if there's more stuff you guys want to know,
Definitely.
then please do either message me, message below, and if we do another episode, in episode 3, we can maybe unpick some further frequently asked questions. We're also going to do the practice ownership kind of one as well. We're going to do the one where practice finances. I think that's 2 separate things. So maybe buying and selling is one, finances is another. And we maybe did we talk about investment at all? Is that something you deal with?
So
Houses.
investing in, so if you're going to purchase properties is probably good, or anything tangible that you're going to put your money into, then the premise is generally the same.
So yeah, those are a couple more things that we're thinking of talking about on this channel. So if you want to see that, make sure to like, comment, subscribe to the video, leave a comment down below if there's anything you want to get into. Make sure to check out Bilal Heath Hill Green on Instagram. I'm also running a bunch of giveaways, and it's really simple. All you have to do is go to the link in my bio on Instagram, or it's actually now in the description of this video. It's a basically it's an email list, and I give you guys loads of dental products which I've got offers on, and I'm thinking eventually I'm going to do monthly giveaways, and you just have to be on the list to get there. So make sure to subscribe to that. I'm only going to be essentially putting things on there that I believe in and I've had a look at and vetted. It's not going to be spamming you loads, so don't worry about that, because I know how annoying that is. I'm also very, very lazy, so I'm not going to be doing it loads. But have a look at that. We have got a couple of different things we've already confirmed for the first giveaway when we hit 50k on Dents of Insta. So ProDent USA are going to be giving us some instruments. We've also got Hassan Magaria, who's going to be doing an Instagram live tomorrow, case presentation. He's got a course called Baird. We may be offering a discount to the people on the list as well, and there's a couple of other people that I'm hopefully going to hear an answer from soon as well. So yeah, guys, been a pleasure today. Make sure to like, comment, subscribe, all that fun stuff. Check out the Heath Hill Green. I keep on saying Heath Hill Green, which is Bilal's account. Follow all mine. There's too many of them at the moment on Instagram. Check out the newsletter. And if you enjoy the stuff that I've been doing, check out the Patreon group as well. There's a couple of different things that you can do on there to support the channel. But this has been great, man. And I'm sure we will be speaking to you guys again soon about more finance stuff. Okay, awesome.